Well, good afternoon, everybody, and a very warm welcome this afternoon to our webinar with Acuitus, Income Analytics, and of course, IPSX. It's great to see so many attendees with us today, and I'm sure we're going to be in for a great session. Before we make a start, though, just a bit of housekeeping. And as has become the norm now with Zoom webinars, please may I ask you to use the Q&A box to ask your questions to the panel. And please, you can do that as we're going along. I'm afraid as there are quite a number of attendees with us today, you are all on mute. So but please do interact with us using the Q&A box. So that would be great. And we look forward to receiving your questions. Don't wait till the end. Please feel free to post your questions as we're going along to any of the panel. So talking of which, let's introduce them to you. And I'm pleased to be able to first of all invite and introduce rather Richard Auterac, who's the chairman and auctioneer at Acuitus. Richard is probably the best known professional auctioneer and commentator on the UK commercial property auction and private investor markets, having overseen the sale of more than 7 billion worth of individual property assets. He has more than 40 years of real estate transactional and advisory experience and was a founding director of Acuitus in 2010. Prior to Acuitus, he was a partner and director of JLL. So a very good afternoon and welcome to you, Richard.
Thank you, Kevin.
Our next panelist this afternoon is Matthew Hopkinson, who is the Chief Commercial Officer at Income Analytics. Prior to co-founding Income Analytics, Matthew co-founded Adobe and has over 20 years of experience of working with market-leading PropTech businesses here in the UK. He was previously a founding director at the local data company, where he established it as the UK's leading data and insights company in the retail sector. Prior to that, he was the operations director with CoStar in the UK, where he oversaw product and data integration with the US parent. He is a regular contributor, I should say, to the BBC, the FT, Sky News, The Times, and many other media outlets. Matthew is also a visiting professor at University College London. Good afternoon and welcome to you, Matthew.
Good afternoon, Kevin. Thank you.
And lastly on our panel today is Roger Clarke, Managing Director and Head of Capital Markets at IPSX. Roger has extensive experience in corporate transactions, particularly in equity capital markets, but also in M&A and restructuring, with specific focus on real estate. Roger spent 20 years working in the European investment banking industry, including roles at NF Rothschild, Dresdner Kleinwort Wasserstein, JP Morgan Cazenove, and Stifel Nicolaus, as well as undertaking a secondment to the UK Takeover panel. Good afternoon and welcome to you, Roger.
Thanks, Kevin, and good afternoon, everybody.
So thank you all to the panel for being with us today. And as I mentioned before, please do use the Q&A functionality of Zoom as we're going along. Well, love to and welcome your questions and to create some interaction. And the way the session is going to work, I'm going to shortly introduce the topic for us, and then I'm going to ask Richard to share with us some views and some thoughts, and then we're going to hear a little bit from Matthew and lastly from Roger. And after that, we'll then have a bit more of an interaction between the panel. So to kick us off, what I thought would be good is just to give us all a bit of an overview. And of course, private investors have historically heavily invested in high street properties. And for many, this was the simplest property sector to buy into. Many of the assets were relatively small lot sizes and pretty affordable. All an investor had to really know was the location and that the tenant was someone they recognized. However, over the last few years, the trend in retail property has reversed as online shopping has surged. And of course, we've all seen footfall in high streets begin to decline. For the property investor, 2021 has also marked a bit of a turning point as both the real estate markets and the high street starts to recover from COVID-19, and demand for space for real estate continues to change by both location and indeed by sector. Direct investment into high street retail assets under 5 million in lot sizes has become an increasingly difficult and challenging market for all but the experienced investor. So the big question is, how can now private investors wanting to invest in commercial real estate that has the promise of a 4 to 6% return get into it? And what are the better, and how can investors, better understand the potential risks when making investment decisions, and what are the alternatives? Therefore, what is fundamental is understanding the durability of the income streams that each property and asset generates, the income and the affordability of the rent by the tenants, and that has now become an increasingly important part of the investment decision-making process. So our panel of experts this afternoon are going to offer their views on what makes these kind of investment decisions, what perhaps we should all be thinking about, the different sectors that make up real estate, and the differences that we're seeing around income generation. And we're also going to have some examples given to us by Matthew that are going to look at and understand a little bit more about the kind of differences that we see in tenant income and tenant mix to give us a bit of an insight into how important this area is. So let's get started with that introduction, and I'm going to now turn over to Richard and help him to help frame the session with a few of his thoughts. And I'm going to kick this off by asking Richard a couple of thoughts and a couple of questions, and hopefully he'll then be able to pick that up in what he is about to say. So Richard, to get us started, what do you see as happening with retail assets? And typically, what are you seeing at the moment that private investors are buying either through auctions with you, or indeed by private treaty? And then potentially, can we also then tackle this point around trends? What trends are you seeing happening in the auction? So, Richard, do you want to pick it up from there?
Yeah, thanks, Kevin, and good afternoon, everybody. I wanted to do some scene setting, but Kevin's done a brilliant job of scene setting. So some of the things that he said, I'm probably going to repeat, but I'll repeat it in my words. I think that what I've done for 35 years is work in the, if you can turn to the next slide, please, that's it. And the slide after that, that's it. Thank you very much indeed. What I've done for 35 years with my colleagues is just talk to private investors. We talk to real people, we interact with real people. And our job is to really understand what motivates them and what they want to buy and what they want to invest in. So our decisions, this is really a distillation of what our buying clients, our investors, have been telling us over many years. So very simply, as Kevin said, over the last 35 years, private investment into the retail sector has predominated. Historically, over 35 years, it's been around about 2/3 of investment made by them has been into the retail sector. It's been as high as over 85%. And last year, for instance, it was 70%. So what's interesting, despite what we read about retail, the private investor is still investing in retail. As a matter of comparison, investment in offices is around about 15% and industrial 10%. But if we look at why it's at 70% last year, there are factors of supply and demand to be considered. The simplest thing, of course, is there are far more shops around than there are offices and industrials. And when you look at the sweet spot for private investors, the lot size will be typically below 10 million and more frequently below 5 million. So there are a lot of retail properties that actually are investable, many more so than offices and industrial. So naturally there will be a greater supply of retail. The other aspect is that you come to the supply side and the owners will say, well, actually, I'm only going to sell those assets that I don't believe that I want to be in the long term. So they will say, I'm going to hold on to those And in a particular example of that, of course, is the industrial sector, where we've seen a real paucity of stock coming to the market by owners, because, of course, they want to retain those assets. And we know that there's a lot of press about the demand there has been for industrial and how yields have been driven down for that. So those investors, those owners don't want to sell that. And also, if they do sell that, how will they replace the income? So looking from the demand point of view, which is very interesting, well, why do the private investors want to invest in retail? Well, actually, it's been historically relatively easy. There's a lot of it. It's relatively small lot size. You can buy most retail investments for less than £1 million. And also, they tended to be on long leases to well-known brands. And also, importantly, when you do have the local investor, they do also understand their local retail environment. Another aspect of retail, of course, is the tenant always fits out the property, but so the owner hasn't got to put his hand in his pocket and pay for that. This is not so for industrial and office investments. Industrial investments tend to come in larger packets, and also the buyer, the investor, is less likely to understand the occupier's business. Whereas, of course, if it's a retail outlet, we all understand the brands and what they relate to. Industrial does have some interesting things going for it, and that is, of course, it's the individual units are relatively small, and if you can package them, get into a small estate, you're spreading your potential risk of tenant failure amongst a greater number of investors. So industrial does have some retail characteristics, and we see that overlap when we start dealing with trade counters. Offices, of course, another thing entirely. These tend to be much bigger, but most importantly, they suffer from obsolescence, which can incur a huge amount of expenditure at frequent periods in their ownership. So for the private investors, retail is by far the easiest. Retail is a sector they want to be in, but as you said, Kevin, we have an issue. Is there going to be stock there that people want to invest in? If we could go into the next slide, please. And this is to talk about the market last year. In fact, I jumped one, but I'll just talk about it. We published a research document last year on how the private investor market fared in 2020 in the sub £10 million market. So we're not talking about the institutional size market, just the sub £10 million market. And how did that market fare during the lockdowns? Well, we all know how difficult it was in the early days of March when liquidity pretty much dried up. But what surprised me was how quickly the liquidity got going again after that March period. And I think the auction market did contribute quite an important role then, because it did provide stock, it did provide liquidity for those who wanted to sell, and also, importantly, for those investors who wanted to continue investing in the market. And our calculations show that at some stages last year, almost half the investments made by private investors were done through the auction room. So it accounted for a very large part of liquidity that we had last year. Just to give you an example, I mean, how quickly it bounced back. Between Q2 and Q3, Q3 was 90% higher in terms of turnover than it was in Q2. The other thing about last year is that we didn't see yields weakening at all for the prime end of the market. Albeit, you know, our yield analysis is based upon the actual price of property that's sold in the room. And of course, that was, you know, selective. So there might be a self-fulfilling prophecy there, but yields remain very firm for those assets that were sold. Q3 last year, Yes, the auction market continued to provide liquidity in the market, with 39% of the assets acquired being bought through the auction room. And now, this is slide 3. Is this slide 3? I think it is. Let me just have a look. If you can go to the next slide, if that's okay. There we are. This is looking at a shopping list of what private investors will be looking for from retail at the moment. It's certainly not a one-way ticket. It certainly requires a great deal more skill now at understanding where the risks are the least. What I can say is that it's UK-wide, but you need to be in a location where there's above average GDP, and quite frankly, there is recovery potential. That's a pretty obvious thing to say, but it's UK-wide. It's not limited just to London. There are hotspots around the country where that GDP and recovery potential is seen as good. Naturally, supermarkets, convenience stores have remained popular. Very, very little shift in yield there. We talk about pharmacies, we talk about healthcare. I think CBRE came out with a report this morning about healthcare. I think assisted living accommodation will be very popular to our private investors, providing it's, of course, correctly priced. What else are they looking for? Well, the key thing is new open market lettings at manageable locations, in core locations. So the biggest issue that the investor has at the moment is dealing with over-rented property, where one is you don't know if the tenant's going to continue in business long enough to the end of the lease because they might go into CVA or whatever. And the other one is, well, will the rent be in 3 years' time? In many cases, no one actually knows. If you have a new letting in a core location, then yes, absolutely we'll go for that. Prime shops in traditionally institutional cities. We know the institutions have exited the vast majority of market towns and institutional locations, towns, cities across the country. They're now focused on the very much bigger conurbations. But you do have cities like Guildford, like Cambridge, like Chichester, where if you're in the core of those, if you're a core location, then why not? Why not get the chance to buy into that location? The core might be shrinking, but you're in that core, and when recovery comes, that'll be where it'll happen first. We also selling Marks and Spencers, BHSs in the high street, but frankly, it's got to offer very flexible accommodation for owner-occupiers, and the private investor really doesn't want to throw a huge amount of capex at turning them into usable space. But if you can find a prime shop and it can be repurposed, then they're looking at those. The final one here I wanted to pick up on was shops with residential kicker. And I think if we go to the next slide, we'll see some residential kickers. There we are. These are properties that we sold last week, so it's bang up to date. And whilst the lot sizes are relatively small, my view is that this is the bedrock of the private investor market. And the private investor markets, the big investors of the future, will start at this, and they will eventually build up to their portfolios of 20 or 50 million pounds. But this is the bedrock of it. And what we have here is a 5-year renewal to a bank in what you would call as neighborhood locations, pretty good neighborhood locations. Shirley has an investment following, so does Leon C, completely different ends of the country. But you can see here that if Santander were to go, you've got the upper floors. You find these properties we all find them right across the country, particularly in the villages of London, the urban villages of London, but right across the country. and you have the opportunity of their buying into a good location. If Santander were to go, well, you'll find an owner-occupier at the very least, and you've got accommodation above. So we call those a short-term bond with equity kicker, a bit tried. If we go on to the next one, please. I mentioned, thank you, I mentioned Greater London. Well, Greater London will sell. It's the GDP is right, it's above average, and this is exactly the place where people want to invest. There's a huge investment demand for this. This is a little one in Wimbledon Village, let to estate agents here until 2030, 4.7%. But you could replicate that right across East London, West London, South London, and North London. Unlimited demand for that. The ground rents, we don't see many ground rents, unfortunately, incredibly popular. This is Caerphilly, the one below, and they had a lease, Morrison's had a lease, even though they're not in there now, to 2064. Caerphilly, high street unit, selling at 5.3%, clearly over-rented, but that shows the power of the ground rent, if you can call it that, or the long lease. Interestingly enough, we had last week a ground rent in Scotland, which sold for 2.7%, which I think was one of the lowest yields I've experienced. So if we go to the next one, next slide. Well, I have to touch on shopping centres, don't I? They've been a lot in the news recently. And we've sold a lot of them. And yes, they will sell. Shopping centres will sell. But they'll sell for what they're worth today. And it's a matter of opinion, great opinion, and debate at the moment, is what are they worth today? Well, when we assess these investments, we strip it right back to basics. We don't have legacy issues of having bought them 5 years ago at 40 million, or having to look at how they were rented out maybe even 2 years ago. We look at what the facts are today. We look at occupancy, we look at the type of tenants, we look at those like to go into CVA, and importantly, we look at where affordable rents are going to be. And we put together this pricing, and it might shock some of you, but frankly, this is what these shopping centres are worth. And I don't believe they're giving them away. When people say this, they're certainly not giving them away. They'll be bought by property companies and private investors who, frankly, many of you will never know or have never heard of before. They certainly won't be mainstream investors. But the important thing is that they're not hidebound by previous valuations, and they don't have an unrealistic view of what they're worth. It takes a lot of work on their part, plenty of blood, sweat and tears, and frankly, not much glamour. This particular one was interesting because I was listening to a podcast just before we auctioned it, and there were 3 experts on the podcast and they discussed it. And they were quite dismissive in a nice way of our chances of selling this. And in fact, they rated our chances of selling it somewhere between 25% and 0, which I thought was great, and that's great for the confidence. Anyway, frankly, we were far more confident. We did sell this, and in pretty quick order, and we got a great deal more than our guide price. So I'm hoping that the 3 that were on that podcast will be listening today, and I think we've just proved them wrong. But we'll come back to shopping centres later on, because you have to look at the income durability of those tenants. If we quickly go on, and I'm conscious of time, this is 7. So what does a private investor, high worth net investor, require from income? Well, he requires a good income return, clearly, with capital preservation. And that capital preservation has been clearly somewhat difficult for a lot of the retail assets. The prime assets have held their own. We know that yields have remained firm, but for a larger part of that, capital preservation has not actually happened. If you ask them, what would you like? Yeah, capital, we like definitely income return. And we'd like to believe that one day we'll get some long-term capital growth as well. But what is important, of course, is that they have to now focus on the covenant, the occupier covenant, and the new leases. And that requires a different skill, a more intense skill. But one of the things that we've seen recently is that as average lease length have come down from 10 years to 5 years over the last 5 or 6 years, they're much more comfortable with 5-year leases, which is good news. If we then go on to the next one, which is just thinking, well, you know, why don't the private investor just quit the direct property market entirely? Well, here are some data from MSCI. Thank you, MSCI. You can see that over the last 10 years, Acuitus is 4.5% total return, bonds 4.8%, property 6.9% over the last 10 years. Okay, it's fluctuated slightly in the intervening years, but over the last 10 years, it's 6.9%. And that was the data that was released last year. So why would the private investor want to ignore direct property completely? In my opinion, they won't. There's plenty of capital sloshing around the world, apparently, so we understand. It's producing a return property that's higher than gilts, or indeed in any interest you might get from the banks. Many of us don't have defined benefits pension schemes anymore. So the sooner we start investing for the future, the better. So the final slide I wanted to focus on is income return for all property sectors. This again has come from MSCI, 4.6%. That might not mean that much to you, but if you look at the performance of property over more than 10 years, the reason why it derives superior returns is the income return. It's the 4.6%. This has just come out, but it's the income strip that is the real driver of property returns. And I think that as I said there, an understanding of the robustness of the income and the ability of the occupier to pay rent will play an increasingly important part of a successful investment strategy. So income is absolutely, understanding income, in my opinion, is the most important thing going forward. On that note, Kevin, I wanted to segue into Matthew, if that's...
Indeed. Thank you very much indeed, Richard. Quite a lot there for our attendees to digest. You covered an awful lot of ground, and thank you for explaining what's been going on in your auctions and where the market is, and beginning to reference this question of risk, and particularly how perhaps investors can start to look at that and think about that. So let's turn to Matthew. Matthew, we've heard here from Richard setting the scene, talking to us about where the market is today, some of these analysis pieces that he was talking to. What's your view? How can the risks of investment be reduced by analysing income streams?
Thanks, Kevin, and hello, everybody. So I think there's a couple of really key stats that sort of almost play out from what Richard said. So essentially, the value of property is determined really by the quality and duration of the income, and that 75% of the value is coming from the income stream. And when you look at this globally, there's about $30 trillion of commercial real estate globally. And this year, 2021, $1.4 trillion will be paid in income. And when you look at the income and you say, well, how secure is that income and how do you measure it? Most people look at you blankly and they say, we've done a credit report. Now, at the end of the day, a credit report doesn't tell you about the likelihood of that business being in business for the duration of the lease, as Richard alluded to. And in the last 12 months, we've particularly seen with COVID, a whole load of sort of, I suppose, forced business failure. We've seen weak businesses which have been taken down, and we've seen strong businesses refusing to pay the rent. So everything's been thrown up in the air. So ultimately, you know, our view and why we founded Income Analytics last year was to bring to the commercial real estate sector the ability to monitor, qualify and measure the quality and duration of the income. And that's what we, you know, later on I'll show you.
Yeah, absolutely. I know you've got some examples to go into that is going to sort of bring that story to life a little bit. Let me bring Roger in. Thank you for being patient, Roger, with us. And let's turn to you. So here we've been talking around how investors are looking at investing in commercial real estate, and of course IPSX is a new stock exchange. What can you tell us that would help investors that are joining us today to understand a bit more about how the exchange is going to operate?
Well, how the exchange will operate, we have set up a stock exchange, IPSX, which is dedicated purely to listing real estate assets, technically listing companies that own those assets. So that means that you can buy a share of a building. So I think it's interesting listening to Richard talk, picking up on, you know, if someone wants to deploy £1 million or £2 million into real estate returns to get your 6.9% total return, you can and will continue to do that with Richard. But now what we're offering is an ability to effectively do the same thing, but for potentially much larger pieces of real estate, giving you a little bit more choice. You know, now you could buy, for example, the first IPO on our exchange will be a building in Birmingham which is worth £180 million. It benefits from all of the things which Richard was talking about, and many of the things that Matthew will come on to talk about. But now you don't need £180 million to buy it. You can buy £1 million worth of it, or you can frankly buy £1,000 worth of it. And I guess that's, Kevin, the most important thing that we're doing, and it's driven by our vision to try and open up direct real estate to everybody, to democratize the real estate markets, open up direct real estate in a listed, regulated, transparent way.
Very good. Thank you very much. We've got some questions that are already beginning to come in. Thank you to Brian and to Andrew for yours. If colleagues do want to be putting forward questions for the panel, then please do. Richard, there's a question here that we have. I don't know if you want to take this now, or you prefer just to pause and to wait.
No, I can do it now if there's time.
Okay, so let's deal with Andrew's question first, and then, if I may, I'm going to come back to Matthew. And Matthew, perhaps you could be ready to tell us a little bit more about these examples of yours. But before we do that, let's take Andrew's question. Andrew's question is Acuitus experiencing a lot of potential business from the banks in the forms of sales where loans have been called in?
The simple answer is no, not at the moment. I hate Acuitus to be accused of ambulance chasing. Obviously, in my time at Jones Lang and at Acuitus, we've been through various cycles where banks have foreclosed on properties, and the latest one back in 2008 did involve us in a lot of pricing work. This has been talked about before. We're not. I think the challenger banks are taking a more robust line. We do know that, and we are working with some of the challenger banks to deal with their customers' consensual sales. We're also dealing with some of the receivers, but those appointments have tended to be probably, can I use the word, fag end of the last crisis, and the new crisis has still to unfold. And our understanding of the banks is that they will be, the mainstream banks, they will be more cautious, more careful about taking difficult decisions against their customers. Of course, this is not a banking crisis, or it's not been caused by a banking crisis, so the banks are better protected, better insulated from it. Sure. I do think, though, that on the retail market, I think there will be questions to be asked when refinancing the asset. What value, what price, what value is that asset now compared with when we lent the funds 5 years ago?
Okay, so well, let's not quite get into valuation just yet. We're gonna pause there, if I may, Richard. I'm sure that's going to be something that Roger will probably want to talk about it for. I'm keen to get us back to where we were beginning to explore this whole idea of analysing income, and I think that's a good cue to get Matthew back. Matthew, bring us back in if you can, and tell us a bit about how it works. The kind of analysis that you do, and what this really means for investors, and then I'm going to invite Roger to comment about some of those points that you're making.
Sure. So the fundamental point I think that we're trying to address here is, as you saw in Richard's presentation, there's talk about fixed income and equities and everything, and commercial real estate sits in this slightly bizarre world of undoubted covenant, BA3. No one quite knows what it is. And traditionally, if you look at credit reports, they're essentially backward looking. So the things that we've tried to address are really sort of fourfold. So one is looking at the risk that a company will fail and applying that globally. So there are 420 million companies, because if I have a tenant that's French or German or British or whatever, I need to have a level playing field to understand what that risk is, and I need it to be a number. It needs to be quantitative. The second thing that we do is we take that 1 year failure score, so the chance of the business going bust, and then we apply it into the bond market and create a synthetic bond rating, because if I went to the bond market with that equivalent risk, what would it tell me? So I've got some language so it's almost Google Translate that other people will understand. The third thing that we then do is that we then go back to 2007 and 8, and we actually look at actual outcomes against those types of companies and project it forward 10 years. So you've got hard numbers that you can apply into your cash flow forecast for the duration of that lease. And then the last thing, the fourth thing, most importantly, is understanding the counterparty risk. And one of the reasons why we use Dun & Bradstreet base data is because of the Duns number. And with 420 million companies, you really need to understand that counterparty risk before you sign up to it, or indeed, if you're going to have a guarantor, understand what the risk is. And those are really the four critical things that we deliver, which we think makes commercial real estate more transparent and more investable.
Sounds very thorough. Let's have a look at some of these examples, Matthew. I know that you've got 4 to take us through, so I'm going to have to push you along a little bit, because I do want to.
We'll go through very quickly. So let's go to the first one.
Thank you.
It's all very similar here. So this is an auction property that you'll see here. It's office and residential. It's a regional city, and you can see there the sort of the commercial rent. Now, what it's showing you at the top right-hand corner is when we look at the businesses in here. So there's a number of businesses, there's 4 businesses plus the residential element, which we don't analyse. It comes up with a strong score, 90 out of 100 in the world in terms of the risk to that income. You take the failure score, and if I was to go to the bond market, that income's equivalent of BBB. And what I want to look at the breakdown of that income amongst those commercial tenants that I was talking about. The next chart on the right there is the tranching of that income by the equivalent bond rating. So you can see it's very strong. The next level below, you're looking at the history of that global score. So you can see it's got stronger over time. And then you can see this projected probability of failure. And you'll all have better eyesight than me that you can see what it is, but it'll be relatively low when you look at that particular score. So that is, a pretty secure income. Now, the other bit that sits in the back of here is it's all weighted by rent. And the 2 bits of key data we collect are the rent and the ERV. So again, understanding that relationship between the rent and the ERV is key. And again, Richard alluded to where will rents be, but you can certainly know where they should be potentially today if it's over or under rented. So there's one example. If we could go to the next one, please. So you then get into a far more complex scenario. And again, Richard talked about shopping centres. And what you see here is, again, very equivalent. You see a weaker sort of income opportunity here potentially. And particularly when you look at the tranching now on the right-hand side there, you start to see very high risk. And in fact, the black is people who are in administration. So when you go into this, and you'll see that the scores come down fairly rapidly, and it's not looking brilliant. And the second thing that we would then do is I would go into the tenancy schedule and look at some of those tenants and start to map out, well, who are my weak ones? Because across there, in this scheme, there's about 30 odd tenants. You'll see a real sort of depth and breadth across the spectrum of people who are basket cases and people who aren't. So again, the asset management piece on this asset would be fundamental going forward. If we could go to the next one, please. We then go into, and this is sort of demo data, your traditional institutional investment, which happens to be a tower in London called Liverpool Street Tower. It's office with retail and leisure on the ground floor, typically, that you would see. And you'd see this, you know, very, very strong. It's got financial services sitting in there, and you can see it's, you know, an A minus. But of course, note that nothing is totally perfect in this world, even in a Liverpool Street Tower. And you've got down there elements of the retail and leisure in administration, which is the black piece. Now, when you look at all of this, say the Liverpool Street Tower, there are other bits you can go in to look at this exposure to your true counterparty in terms of where that risk lies with the parent. And the other thing is you're able to start to map out a number of assets in funds and portfolios, what your exposure is by sector, by country, and by the true global parent. And then we've just got one final one, which is the basis of really everything that we're doing here. It rolls up from the actual risk report on the company. And here's an example, which is probably fairly common within the auction market, where someone buys a single shop, it's got a single tenant. And here's a good example of a retail shop unit, single tenant in the fashion sector. And you can see 50, double B. And then when you look at the bottom scoring of that global history, you can see it's getting gradually weaker, and therefore the risk of default is increasing. The other thing that you'll note is there's a number that says 47,500. The only thing that we do towards credit is we take the sort of credit number provided by Dun & Bradstreet, we divide it quarterly to ensure that if your rent is in excess of that, then rent affordability becomes a key issue. And that's essentially, in a very quick nutshell, what we do.
Okay, thank you very much indeed, Matthew. That's very helpful. Roger, from an IPSX point of view, how does this help with investors looking at securities that are going to be on the exchange?
Well, I think it's really exciting what Matthew and his team are doing. I mean, I'm going to pick up on something that interesting that Richard said earlier on. He made the very good point that as we all now head towards a world of defined contribution pensions, we've got to start to look after ourselves financially. And there's the added thing that, you know, in a low return environment, the fees that pension funds and institutions charge us are so high that increasingly we're starting to all self-invest and look after our own savings for the future. And now, given that most of the people that have joined us today are interested in investing into real estate, I'm going to say something quite controversial. Let's forget real estate for a moment, and let's just look at the average investor who thinks in terms of a 60-40 portfolio. To save for the future, you have 60% in equities, 40% in bonds and other things. If you are actually approaching or in retirement and you're beginning to focus more on income, actually living off your savings, you know, maybe that moves more to a 40-60 sort of change. But of course, bonds don't work anymore. Fixed income doesn't work. More than a quarter of all the bonds that exist in the world today yield 0 or less. Okay, that's only a quarter, but get this. 90% of all of the bonds in the world that exist yield less than 2%. Fixed income does not work for an aging population. And yet that's what we're used to, equities and bonds. But if you think about what I said about IPSX earlier on, the fact that we're securitizing real estate, making it digestible, making it tradable, making it something that can go onto an exchange which is regulated and protected. And then you add to it what Matthew is doing and has just showed us in terms of now being able to rate that real estate, give you, all of you, anybody, the chance to really understand the quality of the income that comes from it. And Richard pointed out how large a constituent of returns income is. Now you can, all of us can see the quality of the income, and you can even score it. So you take securitized real estate from IPSX and add an income analytics rating to it. You've just created something that looks a lot like a bond, and yet it yields 5% plus. That's how important what we're doing is.
Very good. Thank you very much indeed for drawing that out and emphasising that point. Matthew, we've got a question that's come in from our audience today. When assessing tenancy risk, does income analytics look at just the tenant company, or does it look through to the group level when assessing its scoring risk?
The short answer is we're looking at the actual company on the lease is the most important piece, because, and the reason for that is that you can obviously go up and look at the parent company, and a number of our clients will do analysis on the name of the company on the lease and the parent company, or have a guarantor. Because the key thing is that you need to be very careful about mixing the two, because the $1 million question is, if that child company got into difficulties, would the parent bail it out or not? And if you look at the complexity of corporate structures these days, particularly in retail, you will see that not always will that be the case. So you would be creating a misscoring of a company if you were to rely on the global parent bailing them out and therefore taking that score.
Okay, thank you very much indeed, Matthew. Colleagues, please do keep firing away your questions. We've got a few more minutes yet before we come to our end of our webinar. So please do, if there's thoughts that you've got for Roger around IPSX, the kind of securities that we might be expecting to see, or questions around trading, fire that in. If you've got some thoughts for Richard about what's he seeing coming into his auction over the next few months, please fire away. Now, we've got a question here, panel, that I'd like all of you, if I may, to answer, and that's your thoughts, please, on the current rent moratorium. Now, a lot of this has been in the news recently. The Chancellor, we know, has been looking at this. The British Property Federation has been talking a lot about this, and of course, everything that we've been talking about this afternoon sits very firmly around rents and payments of it. So, panel, what are your thoughts about the current rent moratorium? Is the question from our audience. Should it be extended or not? Should there perhaps be certain asset classes that should be protected from this or not? Let's get your thoughts on that. Roger, what would you like to kick us off?
Should it be extended? No, definitely not. I think it's an outrage, the rent moratorium, because I think what the government is doing is effectively asking one part of the private sector to become the welfare state to another part of the private sector. If we need socialism to get through COVID, fine, we need socialism to get through it, but that support should be extended to property owners just as much as to property tenants. So I think it's a terrible thing.
Okay, thank you for your thoughts. Richard, I'll come to you next.
I'm not going to put too much of a political spin on this particular one. What I would say is that I'm very heartened by some of our investor owners negotiating, engaging with their tenants to come up with a sensible rental payment scheme. And we've seen a number of these, and we've actually also sold a number. So the things that we've looked at, or clients of ours looked at, have been obviously step rents, no rents for the first 2 or 3 lockdowns.
Turnover rents, so that's another one that's been...
I was going to come to that. No. And then they've got the idea of step rents. Yes, we believe this will be the future, therefore we're happy to give it at 50% or 100%. And of course, there's also the turnover rents. They're coming back as well.
Yeah.
Coming back, they're coming out as well. I have my own concerns about turnover rents. I think they're really difficult to assess. There tends to be asymmetrical information, so that's difficult. But for me, I think it's encouraged landlords and tenants to look at this pragmatically. And I really can't speak for the tenants who simply just don't talk. I think that puts the landlord and the owner in a different situation, because of course they can't actually get to the bottom of what they've got to sell. But once that landlord's engaged with the tenant and they've come up with a scheme that makes sense to both parties, then those assets tend to become saleable, and we've done a number of them.
Okay, thank you very much. Lastly, Matthew, yeah, what's your view?
So I think it's a very interesting debate, and I think Roger raises an interesting point about sort of central intervention in the market. A number of our clients have been using our scores to try and work out the split between can pay, won't pay, and can't pay, and definitely can't pay, as it were. So I think that understanding that piece is key. And having just been part of writing a paper for the IPF around operational real estate, what has become perfectly clear is that the relationship between landlords and tenants, is never particularly improved. That actually we're really talking increasingly about operational real estate. So you need to understand your tenant's business. And thirdly, that you cannot rely on the lease. Forget whether it's 25 years or 5 years. You cannot rely on that. It has to be on a productive relationship. And the minute you do have a rent moratorium, it's good on one side, but actually not everyone might sort of say, well, let's jump on that bandwagon. And then all the landlords miss out. But the second thing is, then forgets that actually these landlords are businesses in their own right who have commitments on debt and other things, and therefore they're the sort of the last in line. So I can understand where it is, but what I do hope that comes out from it is that people wise up and realize that they must understand the business, the profitability, and the likelihood of success of that tenant that goes into their space.
Very good. Okay, thank you very much indeed, panel. I'm going to move us along. We've got lots of questions coming in from our attendees this afternoon, so please do keep them coming. We'll get to as many as we can. Roger, I'm going to come to you now. There are two questions that have come in on IPSX, and I think what I'm going to do is combine these, if I may. So looking for you to answer these together. The first question is, what is the time frame on the first IPO? Following what was reported in terms of delays at the back end of the next year. What can you tell us, if anything, about that? Are you able to give us any kind of ideas of what's in the pipeline? And the second question, which I'm going to roll in for you to answer at the same time, is, are you able to give us any kind of indication as to what the free floats might be for these particular IPOs?
So picking up the first point about the mailbox was suspended in December. The mailbox IPO, which has been brought to market by M7, was suspended in December. People may all realise or have seen in the news that that was slightly driven by the fact, well, completely driven by the fact that M7 itself was the subject of some corporate activity. It was bought by Oxford of Canada in December. And the transaction couldn't continue whilst the second transaction was closing. It was stated at the time that it would be brought back in the new year, and indeed it will, and it will be back in the public domain very, very soon. I think it's be no surprise to anyone that, having got back to work in January, M7 and their team of advisors have started re-engaging and pre-marketing that. In terms of the free float, the equity value of that deal will be around about 80 million, and I think M7 is able to retain anything up to 75-80% of the equity of that if they want to, and they may well do so. In terms of what else is coming in the pipeline, we're getting a lot of interest from owners of large regional office assets, which is interesting because the very biggest regional offices tend to be quite large deal sizes for regional markets. And so there sometimes tends to be a slightly thinner investment market to address. And yet at the same time, some of those regional office markets have benefited quite well from the lockdown drive to decentralize away from London. So we have office assets coming sooner or later throughout 21 in Leeds and Manchester and Liverpool. Outside of the office sector, we also have a deal coming in social housing, a portfolio of social housing. We are working on a deal of a portfolio of serviced offices, which again benefits very much from the decentralizing ex-London sort of move. Along with a whole host of other things. The pipeline is genuinely quite exciting and covers everything from owner-occupier assets, public sector partnerships. It's going to be something for everyone.
Fantastic. And we've got another question that's popped in, and whilst we're on the topic of mailbox, could you answer this one, please? How does a potential investor source the information if he or she is interested in investing?
Right. So it's not available yet, but the listing documentation I expect to be published at some point in March, and our way you could guarantee to get that is that we are running on our website, it's IPSX.com, an ability for you to register to receive automatic, timely, up-to-date notifications of any new deal opportunities that come along. If you were interested and you went to that website and just registered your name and email address, that would guarantee that you would get sent all the relevant information when it's available. Excellent.
Thank you very much. Matthew, we've got a question here for you, if I may, and Richard, do add in if there's anything you'd like to bring into this. There's been much said recently about mum and pop tenants being better quality tenants than corporate tenants, given CVAs, etc. Does the panel agree with that? Matthew, would you like to kick us off with that one?
So I think that if you split out looking at security of income and quality and duration of income, sort of if we into three slots there, then actually I've looked at a number of very small mom and pop type tenants. And if you look at them, they might not have the highest score or the highest equivalent bond rating, but actually they've been around a long time, they know their business, and you know that they'll pay their rent. So you're less subject to matters on high. You've got far more insight into the business because you're talking to the owners and operators of the business, which you're not necessarily with corporates. I think on the corporate front, it is very, very difficult to cast any doubt because CVA arguably has been used as a weapon to actually create a particular outcome rather than the true distressed business. So I wouldn't have it as a guess to say that, but of course, typically they might have longer leases and typically have a higher rental value. So you're more likely to go for that. But I think people are suddenly realizing, as the person's quite rightly said here, that perhaps it's not as secure and as good as they perhaps thought it was originally. Okay, thank you very much. Richard, do you have anything to add to that?
Yes, I do. Just speaking from experience, as the high street starts to empty at the extremes, as I said already, there will be a focus on the core. With the absence now of many of the national multiples, the mums and pops will be able to get into units that they wouldn't otherwise have been able to afford, which is very exciting. So absolutely, a knowledge of the mum and pop's business is going to be very important from the income perspective. Ultimately, we will get the next surge of national multiples. We will get whatever form it takes, it will happen. And these national multiples will then start to compete with the mums and pops to get into those better locations. But for the moment, the knowledge of the tenant's business, it's not a one-way ticket. You have to have that knowledge. And as Matthew said, that the income analysis is going to be very important going forward. And that's where the private investors need more information, more skill.
Okay, thank you very much indeed. And indeed, we're now just on 3 o'clock, and we should close the session up on time this afternoon. Judging by the number of questions that we've still got coming in, we could keep going and going and going. But what we will do is take a note of all the questions that have come in, and we will respond back to you so that we get answers for you. So please don't think that we're not going to respond. We will, but we've just had so many questions to deal with, we can't quite get round to everybody. Thank you so much, first of all, to all of our audience this afternoon that have taken the time out to join us. I do hope that you have found this session interesting, taking the lid off and looking at the importance of income to real estate assets. I certainly have learned a lot this afternoon. And first of all, thank very much indeed Matthew Hopkinson for joining us from Income Analytics. Thank you very much, Matthew. Thank you very much indeed to Roger for telling us all about IPSX and where that fits and how as investors can engage with it, and the kind of assets, very exciting, are beginning to come up. And finally, a very big thank you to Richard Auterac for agreeing to put this session together with us this afternoon. And Richard, I don't know if you have any closing words of wisdom for us.
Good gracious. The closing words of wisdom would be, I remain incredibly positive about our sector, and I believe that we are in an industry that actually learns and repairs itself. So ultimately, it will be repaired.
There's no question about that, and looking forward to the rest of 2021, I'm sure, Richard.
Absolutely, yes.
Fantastic. Well, panel, thank you very much indeed for joining us. Colleagues that have come into the session this afternoon, thank you for giving us your time. If you want to find more about IPSX, as Roger said earlier, you'll find that up at ipsx.com, and Income Analytics too have got a fabulous site, as indeed does Richard with his. So once again, thank you all for joining us. This webinar has been recorded. We will just be distributing the recording of the webinar so that if you wanted to have a listen back, you can too. But it just remains for me to say thank you very much once again, and enjoy the rest of your day. Thank you very much indeed. Goodbye.
Right.